Well, we got past the FOMC and it's Friday. So I have Mr. Jim Welsh with Macro Tides. He's here to break everything down, everything that we've seen this week in the markets and hopefully make some sense out of it. Hey Jim, how are you doing?
I'm doing good, Blake. How you doing?
I'm doing great. It's Friday and it's always nice catching up with you. I love our talks every week. And if you guys love them as well, make sure you subscribe to this channel. This is all exclusive content on Trader Summit. So make sure you subscribe to the channel and give Jim a big thumbs up for being here every Friday. Jim, we just got past the FOMC this week, plus, five other central banks. One, I know you brought some charts to talk about the
Yeah.
FOMC, but anything stand out this week about the price action, the way things moved? Stocks don't look particularly bullish right now, and I know we're today's triple witching Friday.
Right.
Do you have any thoughts on the markets before we get into some of the charts that you brought for us?
Well, again, in Chair Powell's both his opening statement, Blake, as well as obviously in some of the Q&A that followed, the word uncertainty came up an awful lot. And understandably, because the things that are happening on the tariff front, whether or not other countries are going to retaliate after April 2nd, those are all significant unknowns, known unknowns. And basically, they're in a holding pattern. And I think, as I talked last week, and have written about the last couple of weeks, is for a long time, in terms of the stock market, there were no reasons to sell. Anything that came up, oh, it's bad CPI report, or, oh, we've got a Fed meeting coming up. Those things dissipated very quickly. So buy the dip was the, main go-to reaction to any of those news. That's changed in the last 4 to 6 weeks because there are reasons to sell, not just tariffs, the inflation, the impact on the economy, keeping Fed policy changes kind of at bay. Those are all not positives. And then technically, the market has broken down. And I had talked about the advanced decline we had, I should say, numerous times in January and early February that the S&P is making a new high, the advanced decline line isn't. Historically, going back to 1928, that kind of negative divergence has preceded 10% corrections, and ultimately, if the economy goes into a recession, bear markets. So there were warning signs, I thought, because I didn't think Trump was going to back down on the tariffs, and Wall Street was kind of all of the mind, well, it's just negotiating. And they were wrong, and then we saw the market drop 10%. But none of that has been removed.
Well,
You
Jim,
know,
Jim, oh, okay. Well, then maybe that explains why the bounces have been so shallow. And I've had these discussions with traders in our community this whole week about how shallow the bounces have been, and it's because, which is scary because again, the normal response to any 10% correction that we've seen over the last several, since let's just call it,
yeah,
well, let's just say since the financial crisis in 2008.
yeah.
But any 10% correction since COVID, the COVID lockdowns, you just buy it. And so the price action that we're seeing this time around is a little different, isn't it?
It is. It is. But I think it's important to understand this concept of are there reasons to sell or not? Again, Wall Street is buy and hold. So the bias is to buy the dips and hold even when the market gets a little goofy. And let's say that's operative 50% of the time. Then 25% of the time, you've got these periodic bursts of reasons to sell, like the yen carry trade unwind in August of last year, or the three banks that went under in March of 23 in terms of deposit outflows and all that. Uh, but then you got that final 25% where there are legitimate reasons to sell that don't go away quickly. And knowing which framework we're operating under from a top-down basis, I think is really significant. And so right now, obviously, I think we're in that 25% range where, there are more than one reason to sell, and they're not going to go away for a while. And I think that then leads people to, oh, a bounce, I'll take it. Plus, the 10% decline that the S&P just experienced was the 11th fastest. I've seen five, the fifth fastest and 11th fastest. So maybe it was the 7.5 fastest decline of 10%, going back like to 1950. So what that also means is a lot of people got caught long, Blake, and the market fell so quickly that, gee, they didn't have much time to react because institutions are going to be a little slow on the updraw. And that's another reason why when the bounces have happened, people who had wished they sold 3 weeks ago, do some selling into a bounce.
All right. Well, Jim, we're going to talk about the Fed, and we're going to talk about you're going to talk about the Fed, and you brought a few charts, so let's go ahead and get into them really
Yeah.
quick. And let me grab. I don't know why I can't.
Uh-oh.
Here we go. I'm coming. Just give me 1 second. Give me. I was like, well, I lost my functionality, but that I did not. So anyway,
People have
here
been
we go.
talking about that for a while, Blake.
Yeah, I have been talking about that for a while. I think that was after I breached 50. I'm like, wait a second. I have lost some
Oh, it
functionality.
doesn't get much better, pal.
All right. So Jim,
All right.
explain to us
So
the summary of production projections chart that you have here.
this, the Fed didn't do much and so forth, but I think there's much to be gleaned from the summary of economic projections, the SEP. And first and foremost, obviously, in 3 months, they downgraded GDP growth for 2025 from 2.1 to 1.7. That's a big haircut in such a short period of time. In addition, they increased the core PCE inflation from 2.5% to 2.8. And the Fed funds rate, the two cuts that were projected in December are still there. So when you break it all down, it's like, wait a second, we're going to have a slowing economy, inflation's going up, and we're still going to get two cuts. And what I think it implies is that if you look at that 2026 core PCE, 2.2% is unchanged from December. So what that tells us is effectively what the Fed is saying, we're going to get a burst, if you will, of inflation, but it's going to be quote unquote transitory. It's kind of going to be a one-time thing. And then by the time we get into next year, nothing will have changed, really. We'll still be down about 2.2%.
So,
And
so
that is the guidepost.
okay, so that's going to matter this week because this next week we do get PCE. And
Yeah.
what are your expectations for this next Friday?
It's going to be firm. Again, when we talked, probably a month or two ago about the inflation outlook for the first part of this year,
Yeah.
the first 4 months of 2024 had high inflation readings, both on the PCE and the CPI. And as those things were taken away, there was a real opportunity for inflation to decline in the first 4 months of this year. And it's downticked very, very slightly. We get to May, June, and July of this year, Blake, the takeaway values from last year are really, really low. I mean, in the first 4 months, it was 140 basis points. And then in May, June, and July, I think it's about 20 basis points. So what does that mean? Is that we're not seeing the softening of inflation that would help. And then in May, June, and July, we're going to see inflation hold or move up. And that also might be the window of time where we start to see some tariff inflation beginning to show up in some of the data points. So it's going to be rocky from that standpoint. But
Yeah.
I think the overriding thing is the Fed is waiting for more information in terms of how much tariffs are going to be put in place, how long are they likely to last, are there going to be retaliatory tariffs? This is a the retaliatory thing is a big deal because it means that the inflation impulse will likely last longer and be stronger and higher, which then means monetary policy will respond by not being changed. So I don't think that there's almost zero chance the Fed would raise rates, even if we see a lot of short-term push from inflation, because they do think it'll, again, tariff inflation is kind of a one-time thing. You go through it, it's not going to repeat itself next year and the following year and so forth. But what it will do is mean that the Fed will kind of have to wait for the economy to really slow, the unemployment rate to tick up more than what they're projecting. I mean, they only ticked it up to 4.4 from 4.3 at the end of this year. that will prompt the Fed to do something. So they're in a holding pattern, and the only thing that's going to get them to change will be clarity about what's going to happen, and or the economy slowing more materially than what they anticipate. So again, going back in 2018, the Fed analyzed the tariff stuff, and they decided it was going to be not that big a deal, one-time blip. We're going to look past it and look through it. They're kind of saying the same thing right now. The difference is that the inflation push could be far more significant because the amount of goods that are being targeted for tariffs is at least triple what was done in 2018. So, to me, this is the reality where the Fed is kind of have to wait for, more data, more input, and at the same time, that increases the risk because the rates where they are right now are somewhat restrictive. So the longer you stay there, you're adding to the potential weakness. And I think what the Fed is saying, the result of higher tariffs is slower economic growth, in part because you have this uncertainty that is keeping businesses from making business decisions regarding expansion, maybe hiring more people, and so forth. Consumers bracing for more inflation. But all of that means weaker economic growth. And at some point in time, the Fed is going to have to respond to it, but they don't want to be preemptive because they really don't know what the inflation impulse, the magnitude, and longevity is going to be.
Well, that's why everybody's talking a bit stagflation, and that's what this next chart is. Explain
Yeah.
to people what stagflation is, just for those that don't.
Yeah, I mean, basically, it's economic growth and higher than, if you will, normal inflation. Now, this really, got its impetus back in the 1970s, where inflation was much higher, consistently throughout the 1970s, with bursts in 1973, 74, 78, and 80 because of huge increases in oil prices. So I don't think we can compare this episode of stagflation with what happened when that term, I think, was born in the 1970s. But it does show, again, the concerns that people are, whoa, wait a second, we're going to have slower growth and inflation is going to be moving up. That historically is not a good recipe for the stock market and probably not a good recipe for the bond market either.
Okay, and but as we're not the only country experiencing stagflation. This is kind of a worldwide phenomenon, right?
Yeah, yeah. I mean, economic growth in Europe got upgraded 2 weeks ago because they're going to spend a lot more money on defense and so forth.
Right.
So instead of having pathetic economic growth, it's going to be, maybe it'll be 1 to 1.5%, which is not that robust. The inflation surge from tariffs over there is going to be much like the inflation push we're going to see in this country. And that's why the retaliatory response, Blake, I think is critical because if we see broad retaliatory tariffs, now the EU, I believe this morning, said they're going to wait until mid-April before they respond. So, that's showing some restraint as opposed to April 2nd, you do that, I'm going to do this. So we'll see. That's why the retaliatory tariff story is, I think, really, really important. And hopefully between now and let's say mid-April, more things can come to pass. The one thing maybe I'll do it next week. I have a table showing the amount of tariffs that Canada has put on U.S. exports for years. I mean, we're talking like 150%, 250%. I mean, it's very significant. A lot of dairy products and so forth. So it's not, and I think President Trump is doing a terrible job of communicating. Oh, they've been ripping us off for years. Well, show us some numbers to back that statement up. And so showing a table, hey, these are the tariffs that Canada has been applying against the U.S. exports in these categories. But for whatever reason, that doesn't seem to happen. But that's real stuff. Same way with Europe. They have tariffs in place and that have been in place for many years. um, that are way more than the US's. So there's a legitimate discussion to be had about all this stuff. I'm not sure bludgeoning, especially good trading partners, comrade in arms, is the right approach.
But
But
it's the approach being taken.
yeah,
Yeah.
absolutely. And that's what you have to deal with and the fallout that it potentially will create. At the end of the day, I wrote in the March Macro Tides because you look it up in the 2018 episode, Blake, the analysis that was done after the fact said, you know what? We actually saw a decline in manufacturing jobs, not much, but a small decline. And the economy was hurt very, very slightly. So tripling the tariffs relative to 2018, again, this has not historically been good for economic growth and so forth. To me, tariffs is not, it doesn't promote free trade. And historically, globalization, more trade has been beneficial for most of the countries. Now we need, hopefully, the best outcome, Blake, would be if some of these countries are convinced to roll back some of their tariffs. In other words, that's the outcome. Instead of 200% plus tariffs from Canada on various products from the US, maybe it drops to 100%, or 50%. You know what I'm saying? That would be a real positive step. But you have to go through all the commotion and dislocation potentially to get to that point.
Which,
So,
just for the record, you guys are all going through the dislocation right now. Just for the record.
just that
Uh,
haven't
yeah,
noticed,
yeah. If you haven't noticed, all right. So the next chart you brought is the Fed put stories. So this
yeah,
is funny, and this is I can't tell you how many texts I've gotten from people that are like, the Fed's going to move now. They're going to cut rates, and they're going to save us. I've actually gotten those texts from multiple traders in the
yeah,
last few weeks,
yeah. And this,
and I
this,
don't believe it. I don't believe
yeah,
it.
well,
Go
it
ahead.
shows, I think, naivety. It reflects people who really don't know much about monetary policy, don't understand where the Fed is at and the dynamics that are shaping monetary policy at this point. All they know is the market's down 10%. The Fed's going to come and rescue us. And I'm sorry, the Fed isn't coming to rescue you or me or anybody else. Again, it's going to be predicated on the magnitude of the tariffs, how long they think they're going to last, and what happens to unemployment. And if unemployment starts to significantly tick higher, they will respond to that irrespective of whatever inflation bubble there is. But there's got to be a degree of pain from unemployment data to prompt them, not because the stock market's down 10% or 15% or something like that. So I too, when I saw this, I kind of chuckled. It's like, wow, a little bit of pain, and it's like, oh my God,
I
when's
know.
the Fed coming to rescue us?
Expect and this goes to your next chart. You're like, okay, let's see what happens with the stock market after a 10% correction. So what is it? And
Yeah.
tell us what we're seeing here.
Yeah, basically what it shows is the market goes down 10%, and that little red circle in the middle is kind of like, okay, the number of days from the time the market peaked till you get that pullback, all right? I think that's what that is. But the circle represents where we are right now. And what you can see, even under the most bullish scenario, which is the black line, you have additional weakness for a period of, 1 or 2 months before maybe the data comes in and isn't as bad as people were fearing. And then you're off to the races and there isn't a recession. In a sense, we had this kind of like in 22, except the decline, the S&P was down 27%. And people were really worried. They were convinced there was a recession because of two negative quarters in the first and second quarter of 2022. They were wrong and the market took off. If instead, though, instead of, gee, the data starts to turn over the next few months more positively, instead you get the data deteriorating, then you go down and, the market experiences A decline going back, I don't know, that's 7 months, approximately 6 to 7 months.
Yeah.
The average bear market in over time has been a decline of 36%. So that's why all of this stuff is going to be really important in terms of how it plays out over the next 60 to 90 days. People are bracing for a recession. That's contributed to some of the selling pressure. As you noted, every rally gets sold into, pretty quickly because this is one of their people's concerns is, all right, the data so far doesn't show that we should be worried about a recession. They're anticipating weaker data, and then concerns will mount even more. So,
Well,
here we are.
I'm excited to see what the next chart is because this is going to be how you view the S&P from an Elliott wave standpoint. And I'm going to tell you what,
Yeah.
Jim, I took a sneak peek and what I realized is you're not showing us lower end of the chart, which means you're turning bullish here. That's not what I wanted to see. I wanted to see
No,
death
no,
and
no, no, no,
destruction.
no, no.
What's going on?
The thing is, if I go back in time to show lower prices, all the data get incredibly crunched, you know.
Yeah.
So last week when we spoke, I talked about, how oversold the market was. Sentiment had shifted pretty quickly. A month ago, people were very optimistic, and all of a sudden, it's like, oh my God, the sky's falling. When's the Fed going to exercise its put? And so the expectation was that we would see a rally to 57.50, 5,800. It got to 57.15. We've had this pullback. You can see I put this chart together very early this morning. The S&P's so far held above the low we saw on the initial pullback at 55.97. And
Yeah.
so to me, my expectation last week, Blake, was we'd have a rally that would last 7 to 10 trading days. And it's likely to be choppy, which of course it has been. I think we had three waves up to that 57, 15. I think that's wave A. This pullback is a B wave. Wave A was a little over 200 points, from 55.04, 57.15. If I add 200 points to the low today, you're up around 5,800. I think there's a potential that, that we're going to see additional strength, but then I think the market's going lower.
Okay.
And so
So
next week or
initial
so,
strength.
maybe we'll
So
see the.
go ahead.
I was going to say, I'm just poking fun at you a little bit. If I'm right, then the part below there is going to show up with lower prices. So
Okay, so just for reference, and I want it from a very, very basic technical analysis
yeah,
formation. This is what we call a bear flag pattern, and it's
yeah.
actually breaching below today. So I'm a little less
How much is the S&P down right now?
I'm a little less bullish than you are at this point. I'm a lot more bearish than you are at this point.
Okay.
But that doesn't mean I'm right. I'm just saying that that's how
No, I
I'm
hear you.
viewing things right
Well,
now.
where's the S&P right now? Because,
We're at the same price, basically 56.15. So we're right
okay,
here.
we're
Um,
hanging there.
yeah, we're hanging in
We
there.
could take out that 55, whatever that, oh 07 or whatever
Oh
that
four,
number is.
yeah. Yeah.
Well, no, I'm talking about the middle one. Oh, just above the
Oh,
V.
55.97. Yeah.
Yeah, you could take that out as long as you hold the 5504. This pattern has some probability
Okay.
of developing. All right. At the same time, I am negative. I mean, I'm just saying you get this counter trend bounce after a 10% decline, then I think we're going lower.
Yeah.
And is it down to 4,900, 5,100? Possible,
Yeah. Yeah. That's where that the flag actually points to 5,100. So
Yeah,
that makes
yeah,
sense to me. But
yeah,
it is today. Just I know you guys are watching this on a Saturday or on a Sunday with your cup of coffee and you're enjoying your weekend. So who knows where the market end up closing? But it is triple witching, and so you're going to get some volatility a little bit here.
volatility
I would
associated
assume.
with that. Yeah.
Yeah. Let's talk about gold because gold finally today looks like we're seeing some selling finally.
Yeah.
How are you viewing gold here? I mean, I know we've been looking for a high. So is this
Yep.
it?
Yep. It's possible. I mean, what you can see is from that recent low at 20 something 35, is that right?
Yeah.
Hey, 28.35. One, two, and then there's a little three, and then a little sideways that could be four. My point is, and as I said last week, the main point from my perspective is that from the low at 25.41, you can see one up, two down, three, wave four pull back to that 28.35, and we were in wave five, and that we were going to see one more push up above 3,000 to potentially complete the rally from the 25.41. And maybe more importantly, Blake, a five wave rally from the September 22 low of 1616. All right. So we talked about last week the RSI divergence, which has been maintained despite the higher high. The table is set for, I think, a $300 decline in gold. The first target really comes down to about the 25.41. That's wave four of lesser degree. And maybe 2600 just because chart support is there as well. So, my take last week was it's time to be a seller into gold.
Okay.
And
Okay.
and whether there's one more, there could be one more little pop. Like, in other words, all we've had is one, two, three. That 3056 is the high of three of five. This drop is four of five. And then there'll be one more pop. But you're talking about, as somebody likes to say, picking up dimes in front of a steamroller. You know?
Yeah, right, right. And I mean I still struggle with a reason to see a gold turn lower, but when it's that bullish and it's so lopsided and there's really no visibility for the to argue the other side, that's when you have to be a little bit more cautious, I think, than ever, right?
Yeah. Well,
So,
look at over on the left-hand side where you have wave three, okay? And you can see you had a dip and then you went up to 2789. You made a new high, and look at what the RSI was doing. And then, it dropped from 2789 in a handful of days to 2541. That was 240 some bucks very quickly.
yeah.
And I just think the table is set for that. And if we look at the dollar, I think there's the potential that the dollar will get some kind of a bid, um, after April 2nd with new tariffs going on and so forth. I think the next chart is the dollar, you know, as
Actually, the
Keaton.
next top chart is TLT.
Oh, I'm sorry. We'll get to that. Okay.
Yes.
So I'm looking at TLT and Treasury yields. I think, to me, it looks like we're going to see TLT decline more from the rally of 84, 89 or whatever up to the 92.79. The 50% retracement is 88.84. The 618 is 87.91. And guess what? You got five down from that high at 101.64. Three waves up. So you can't eliminate the possibility that we're going to see TLT go all the way back down and take out that low. I'm not in that camp firmly. I think more likely is we had this bounce, we'll get a retracement, and then there's going to be another rally coming as we see more data come in showing the economy slowing. But near term, I think we're going to see treasury yields go up, and that will translate into a decline in TLT.
Okay. Well, you've been looking that for a while in TLT for this like kind of recovery and potentially another decline. And but the trickier one, in my opinion, is the dollar, and that's the one that we're going to get to right now.
Yeah, yeah.
You've been looking for a lot lower dollar. Now, the dollar is trading at its highs of the session right now,
Okay.
but you're still looking for a further decline, correct?
Yeah, when we talked last Friday, I thought a bounce towards 105 was likely given, how oversold the dollar was. That bottom panel shows the RSI. That dollar was below 30, its RSI. But from the top at the 110.17, you can see one, two. I think we probably finished wave three in the last week. we're in wave 4, and my expectation is that there'll be another drop
Oops.
below 103, closer to 102, that will follow on. So what we could see here, Blake, is anticipation of the tariffs causing the dollar to get a bump, or when they are actually announced and so forth. That wave 2 high, that was February 2nd at 109.88. That was February 3rd when the initial tariff announcement was made. Big spike. Okay. I think there's potentially an echo of that coming, that when the April 2nd tariffs are announced, that will probably give the dollar a boost. And then after whatever next rally shows up, I think the dollar's going down below 100, and I think potentially at some point in time it'll make a move toward 95. And this is kind of been the position for really the last 2 months, that top at 110.17 was pretty significant, and that was setting the dollar up for a decline of 15 points.
And Jim, you've been talking about that for a long time. I mean, this is,
Yeah.
I mean, you've been looking for, the dollar to eventually slip into the 90s, which back when you first said that, I was like, I don't see it, but hey, it's been happening. So,
Yeah.
guys, if you enjoy these videos, make sure you give Jim a big thumbs up. Jim, how do I as a trader listening to your analysis get a hold of your technical
Yeah.
review?
Send me an email, Jim Welsh Macro at Gmail, and I'll happy reference, Blake and these conversations that we have, and I'm happy to send you the recent weekly technical review. If you want a bigger picture outlook in terms of tariffs and all the rest of it, I went into a lot of detail in the March macro tides. So the monthly letter is more fundamentally focused. The weekly technical review, as the name implies, is way more focused on the technical side.
Well, Jim, I appreciate you. And I know traders have been listening to our conversations for at least the last 3 or 4 years. We've been doing these maybe 3 years. I'm sure they do as well. So make sure you jump down in the comments below
Thank
if
you.
you have any questions that you want to ask Jim personally. If maybe there's something that you want clarification on, make sure you get down there in the comments. Jim, I know, reads all of them.
I
Jim, I want
do.
to thank you for being with us, and I want to wish you a great weekend, and we'll see you next week.
Thanks, Blake. Same to you, big guy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.